Our next guest says that the survey suggests that a recession is probably unavoidable at this point, and the focus is likely going to shift towards the severity and duration of an economic downturn. Joining us right now is Peter Boockvar. He's Bleakley's financial group, Bleakley Financial Group's chief investment officer, also a CNBC contributor. And Peter, you look at this realistically, and it was taken at a pretty difficult time. I think it was March 27th through April 5th, was it?
Yep.
And you read into this what? We just had someone telling us that, look, it could have been worse than even the numbers that we saw, but the numbers we saw weren't great.
Well, what's unusual about what we're seeing with the banks is typically banks fail or they tighten lending standards after you're already in a recession, because it's the recession that causes the bad credits that causes then bank distress. This time around, it was the very sharp rise in interest rates that created the deposit flight, then tightened lending standards, then created the duration bubble that has now reversed, as we've seen with some of the ones that failed, and then a further tightening of lending standards before a credit downturn has really begun. So this is very different than what we've seen in prior times. And now that we have the credit cycle ahead of us, that tells me with lending standards already tight, they're only going to get tighter. The extension of credit is only going to get crimped from here, and that will, in my opinion, inevitably lead to a downturn and contraction in the economy, which is only growing at best 1% anyway.
Right. And you think that contraction will catch up when? You think it's already happening?
Well, I've looked at the economy in 2023 as two parts, one pre-SVB, one post, and I think that the second quarter is going to where the reflection is going to be in terms of that slowdown. I've listened to a lot of earnings conference calls and a lot of commentary about the back end of March into April, business slowing down. So if we only grew 1% in the first quarter with the benefit of a good January, February, to me it's going to be tough to avoid a contraction in Q2. Even though the estimates are still for positive growth, I think it's going to get more difficult as the quarter progresses.
Joe Amato was just with us and said the surprising thing to him in this report was that businesses there was less demand for these loans, too. Now, it wasn't just a situation of bank standards kind of tightening up, that businesses were less likely to seek out a loan. Maybe that spells a little bit of the kind of freeze that's happening right now. And I don't know how much of that is built around the panic of what was happening with SVB at the time.
Some of that, but also some of it has to do with inventories, because a lot of companies use their revolvers to finance inventories, and we know that inventories are elevated. The wholesale inventory data yesterday showed the inventory to sales ratio at a multi-year high. So I believe that companies are probably dealing with the inventory that they already have, thus lessening the demand for credit until they work down those inventories.
The things that you'd be watching most, Peter, the next kind of indication, the next best read on what's happening with credit will be what?
Well, now we have to watch the delinquency cycle. We're already beginning to see it in subprime autos. We have to see how companies are absorbing this very sharp rise in interest rates in terms of the floating rate debt that they've had. We know that banks will continue to slow the extension of credit, and non-banks will step in, but non-banks are going to be offering double-digit type interest rates. So I think it's the credit cycle, particularly in real estate. We know we've talked about a lot. That is what is next here. And the Fed doesn't need to raise interest rates any higher in order to further tighten policy, because just keeping rates high for a while is itself a continued form of tightening, because every month, every quarter that goes by from here, somebody's debt is going to be resetting at a much higher price than the loan that is maturing.